Are you thinking about what I'm thinking about? Refinancing? Okay, if so, you need to listen to this tip. Okay? Um yes, I'm here tonight to speak with you about refinancing because I know this is a time when most homeowners are thinking about refinancing. And that's normal because now it's the time when the interest rate is very low. Okay, so many homeowners are taking advantage of that, and why not you? Okay, so now, but there are some very important tips, okay, in terms of good information that you need to have. I mean, let's say basic information, mortgage information that you need to have in order to make the right decision, when you decide to refinance. First thing first, my name is Wilkins. However, some people call me Jean Paul. That's probably cool, right? Jean Paul. But it's because my first name is Jean, my last name is Paul. Okay, some people just call me Jean Paul. But my name is Wilkins, which is my middle name. Anyway, I am a licensed mortgage officer, and my license number is 1944722. Just in case you want to check me online to find out who I am. Again, my license number is 1944722. I am a mortgage loan officer. Okay, so what do you need to know first to find out if you qualify to refinance? That's the first thing. You need to qualify. To qualify to refinance, you need to have a steady income. A steady income. I mean, if you are collecting unemployment now, unemployment income cannot qualify you to refinance. If you are working for a company, so you want to make sure you have 2 years of working history. Okay, it doesn't matter. I mean, you don't necessarily have to be with your current company for 2 years, as long as you have 2 years working history. I mean, straight 2 years history. Uh, if you are self-employed, you want to make sure you have been self-employed for at least 2 years. Okay, and your debts, your house expenses, your house expenses. That's the total your total house expenses. That's what we use to calculate what we call debt to income. Your debt to income ratio has to be should not be any higher than 43%. 43% is the top. It's when we divide your total house expenses by your total monthly income. Okay, so you want to make sure of that. I mean, your debt to income is not any higher than 43%, and how much equity you have in your home. Okay, you want to make sure you have enough equity on your home to qualify to refinance. Um, and at this time now, because so many people are just taking advantage of the low interest rate in the market, so the demand is very high. So many people are buying houses at this time. So chances are the value of your house is high in the market now. And to find out, you just go to Zillow.com and then put your current address, and then you will see how much the value of your home is listed online. So you want to make sure of that. So now, say you qualify. What's next? So next, before you refinance, you want to make sure that you plan to stay in your home for a while. Okay, because if you plan to sell your house within the next year or two, so what's going to happen now? You're going to lose money. Why? Is because every time you refinance, you pay for closing cost. Okay, but what's your goal? What is your plan to refinance? Most of the time, people refinance to save money. Okay, to lower their mortgage payment by getting a lower interest rate. Okay, let's say now your mortgage payment is $1,000, right? and you refinance now, and you refinance, you get a good deal. Your mortgage payment goes down to $800 a month. So that's a saving of 200 every month, all right, for you. So 200 a month, say 200 saving a month, that's about 2400 a year. On average, closing cost can go as high as $5,000 to $6,000, sometimes even higher, okay? But on average, say 5 to 6 thousand. Well, let's say your closing cost, is $6,000. So it will take you about 2 years, okay, to recover your closing cost by saving $200 a month. If your term, if you, if your mortgage term is 30 years, for example, yes, it's worth refinancing because you will recover your $6,000 closing costs within 2 years, and you have 28 years left to keep $200 saving in your pocket every month. Then it is worth refinancing. Same thing, by refinancing, you can also take advantage of a lower mortgage term from 30 years to 20 years, or even 15 years. Depends on your income, how much you can afford. Of course, lower you go with your term, higher your mortgage payment will be. That's for sure. But if your credit score is good enough, okay, and you get a very low interest rate, so I mean, I would not advise you to go as low as 15 years, but say 20 years. Depends on how much time you have left to pay off your mortgage as well. Okay, let's say you have 26, 25 years left to pay off your mortgage, then you can easily try, to get a 20-year term mortgage. So if your interest rate is low enough, you may not, save money on a monthly basis, but you will save a lot of money in interest, because hey, you have 26 years left to pay off your mortgage, and you refinance to a 20 years. So that's, you will save interest in 6 years, and that's a lot of interest. That's a lot of money you will save in 6 years. Okay. Um, but hey, say you refinance for 20 years and you save $200 a month, and you plan to stay in your home for the you know for the life for the life of your term, meaning for 20 years, you will recover your closing cost again within 2 years, and then you have 18 years left. I mean, 18 years to keep $200 in your pocket every month. So it is worth refinancing. But again, if you plan to sell your home within 1 or 2 years, refinancing is not a good option for you at this time. So now let's talk about your credit score. Your credit score should at least be 620, okay, to refinance. And let's talk about equity on your home. So because there is a chance for the value of your home to be high at this time, even if when you were buying your home for the first time, you did not have 20% to put down to avoid paying for PMI insurance or MIP. So I'm going to tell you the difference between the two, because anytime you don't put at least 20% down when you're buying your house for the first time, yes, you pay for a separate insurance that that is added to your mortgage payment and make your mortgage payment higher. Okay, so when you are refinancing, you want to make sure you eliminate that. You want to make sure you have enough equity on your home to keep at least 20% equity after they add all the closing costs to your current balance and everything. Okay, and then say When you were buying your house for the first time, they put you on an FHA program because you did not have too much to put down, because that's the goal of FHA. FHA is a government agency that makes it easy for lower income people to buy their first home. Okay, because all they require you to put down is 3.5%. Say you're buying a house for $100,000. You don't even need $4,000 to put down to buy that home. So, hey, it sounds good, but at the same time, they make you pay for a separate insurance called MIP, which is mortgage insurance premium. Okay, it's a separate insurance, that is added to your mortgage payment. So now, if you are refinancing now and you have enough equity on your home, you want to get out of FHA and put yourself on a conventional loan. Okay, because people sometimes think because it's a government program, it's it's better than a conventional loan. No, no, it's in fact you are, if you stay on that FHA, okay, you will probably pay that insurance, that MIP insurance, for the life of the loan. However, if you put yourself on a conventional loan, even if you don't have 20% equity, say you have 18% equity, for example, within the next 2 years, you keep making your mortgage payment and then you reach the 20% equity on your home, then they should eliminate the insurance you pay for conventional, which is called PMI. For for FHA, it's MIP, mortgage insurance premium. But for conventional, you also pay a separate insurance too. They call it PMI. That's private mortgage insurance that you pay on a conventional loan. So basically, this is a very, very good time to refinance for more than one reason. First, the interest rate is very low. And second, the value of houses, of homes, are going high because the demand is high. Because so many people are taking advantage of the low interest rate in the market to buy their first home or refinancing. So now value of houses in general is very high. So it's chances are the value of your home is very high, and that will give you enough equity, okay, to keep at least 20% on your loan, so you can get rid of the MIP insurance that you've been paying since the first time you bought your home, or the PMI insurance you're paying if you are on a conventional loan. So I hope these tips, you follow them, you understand everything that I shared with you, and I hope you use them for your advantage, okay, because they're gonna help you to make the right decision, and then they're gonna help you in different ways, because by having this basic information, okay, that will prevent you from being misled by by a loan officer, for example, okay, because you know what they're talking about, what they're going to talk to you about. You have at least an idea of what you need to refinance, and in which direction you want to go, instead of them telling you, okay, I'm going to put you on an FHA, or I'm going to put you on a conventional. So at this time, okay, why you should be on a conventional loan, and why you should be on an FHA. So again, my name is Wilkins. My mortgage license number is 1944722. Follow me on Facebook. Next time, I will share very good information with those of you who are wasting money, okay, on renting houses. So once you have a steady job and you have good credit, there is no reason not to buy your first home. Next time I will share the process with you, because sometimes people get scared because they don't know the process, okay? So next time I will share the process with you, and then put you in a position to save a lot of money, because you will be surprised after you buy your first home to find out your mortgage payment is way lower than what you are paying now on rent. Okay, so again, my name is Wilkins. I stop here for tonight, and I will see you again later. Good night.